Now we move forward. This is another way to adjust the economic profit metrics for the profile of the business model of the company. And I'm now presenting the conception developed by Stern and Stewart, who organized many years ago a really very successful consultancy company on value-based management of businesses. And the conception is called economic value added, which is another way to compute economic profit. And the special role belongs to the so-called equity equivalence in that conception. Let's go step by step. Now, at that slide, you see the regular, traditional, from the first glance, representation of the economic profit when we are multiplying capital employed by the spread between return on capital employed and weighted average cost of capital. But what's new here? You see that the capital employed should include so-called equity equivalence, or specific sum of the resources which are not properly shown in the financial reports. And they are called equity equivalence, just to focus your attention that some resources are missing in the financial reports. Some of the resources already included in financial reports should be adjusted, and I will show you these different types of adjustments in a few minutes. So it says that really new expression equity equivalence, that now we need to install them into the report about the assets and the capital of the company ourselves, like homemade improvements to the financial report of our company, because some resources are really applicable, we really rely on them, and they may really become even dominant resources, let's say in case of intellectual capital components, but they are still not included into the financial report and into the balance sheet. So the capital employed should be restated, and you will do it just not because financial reporting standards already changed. No, you will do it for your internal purpose of your strategic analysis, because you need much smarter understanding of your resource base. You do feel that your resource base is really wider, is really bigger than the total sum of assets really shown in the financial report in the balance sheet. So the capital employed will have that particular type of an adjustment, but from that follows that when you're computing your profits, you will also consider the problem of the equity equivalence, and how you're going to do it. We will show it throughout our steps which follow. I would like also to focus your attention on some technical part of that slide. I'm applying here always return on capital employed and capital employed, like CE and ROCE abbreviations, but in some other situations you may meet ROIC and invested capital IC instead. Let's think about them now as synonyms, just to not to bear in mind some particular technical differences that may really exist between ROIC and return on capital employed. So no PAT, net operating profit after tax, should be adjusted to this equity equivalence first and to the so-called accounting distortions I will show you in a few minutes. And the denominator when computing return on capital employed also should be adjusted. Your capital should include equity equivalents, which are homemade assets, which is in addition to the equity, as this interesting creation equity equivalent says. So how we are going to think about this equity equivalence? The first type of equity equivalence is from the area of so-called accounting distortions, because the financial reporting and financial accounting, of course, nowadays are accrual-based. But then from that follows that the special role belongs to different types of the reserves the accountant should have when making the accounting records and when preparing financial reports. Imagine doubtful debts and bad debts. There is, of course, some difference between these two different types of debts of your clients. This is the result of accrual-based accounting, as you know, because you still didn't get money for some products that you already delivered to your clients. In case of doubtful debts, you do hope to get the money finally, but maybe really beyond the predetermined date that was included into the contract with your customer. So the reservation technique that accountant will apply slightly differs between doubtful debts and bad debts. But let's look now through the strategic but not accounting point of view on this event. If you have those clients, among those you will have, let's say, imagine first many of the customers which are behind these doubtful debts accounts. Plus, you also have those customers who are behind your bad debts accounts. But bad debt means that you do not hope to get the money in a reasonable time back from those customers. From strategic point of view, the question is, why do you communicate with them? Why do you still have your business with these particular types of clients? And then if you see that the doubtful debts as well as bad debts are increasing through time, and it's reported in your financial statements, then from strategic point of view, we have to say, well, those guys will need them still. So this is our clientele, and we do not have something much better. It's not easy to get rid of even from those customers with bad debts immediately, and we still continue communicating with them. So from that follows you need to make some specific adjustments when computing your expense, because bad debts and doubtful debts, this is an instrument which increases the expenses when you are trying to understand your accounting profits. So maybe in some situations when you understand that they are those positions in the accounts, they are increasing, then this is the signal something is not true, something is not really good, smart in your strategies. You may also think that increased doubtful debts as well as especially increased bad debts, this is like a technical device to make an impact on your profits. So from this follows that maybe you will return these expenses back, and it will mean that your profits should be bigger than they are actually shown in your financial reports. Remember again, we are talking about internal analytics. We are talking about strategic vision. So the summary is, if they are increasing, it may happen due to your accounting policy, to your window dressing policy, when you want to apply those accounting techniques just to make an impact over your profits, just to show them slightly lower than they are actually, and they should be actually. That's why these accounting distortions that may happen due to this window dressing initiatives of your accounting department, when you look on your value creation processes, may be like, let's say, a barrier for you. So maybe for internal purpose, you will think in terms of returning back doubtful debts, at least to the computations of your profits, and profits will increase by that amount of expense that was at first subtracted when you were making those types of reservations. That's one particular type of potential equity equivalence. So your profits could be really a little bit, but higher than they happen to be in your financial statements due to this reservation technique and window dressing policy. On the right-hand side of our slide, we also have some additional accounting distortions from the point of view of economic profit analytics, because here we are looking at the so-called extraordinary items, which are potential gains or potential losses on some operations, on some transactions, which do not represent really operating activity of the company. But we should start computations of our economic profit within that conception of EVA, economic value added, with the net operating profit after tax. So we need to get rid of these extraordinary items because they are not due to the regular operating activity. In case of gain, we need to subtract that gain, let's say, on sales of vessels, because it's not your operating result and it's not regular action. In case of loss, you need to add it back. In the middle of that group of equity equivalents, we will see the most interesting and the most influential type of the potential equity equivalents, which could be called strategic expenses. Those are the expenses which follow the logic of the financial reporting and accounting standards, formal standards, but in strategic vision, you may think about them as not about the expenses, but as of a type of your capital expenditures. Let's say so-called market building expenditures or personnel development expenditures. To build your market, your customer base, you need lots of money on the annual basis to be spent on your marketing research, on your promotion activities, on your advertising activities, to retain your clients and to get the new clients from your competitors. So if you have your arguments, internal arguments, that those expenses, they were really efficient, productive, so they brought you additional customer base, which still stays with you. So you made those expenses within one particular year, but you've got your customer base in that year and it's still with you, still with the company for some other additional years, let's say. So it looks like you made an investment some years ago, spending money on this marketing, advertising, promotion activities, and you've got your benefit stream spending those money, not just for one period, but beyond one period, like in each traditional, typical investment project. When you invest money buying some long-term assets, you hope to get the benefit stream well beyond 1 year. The same is true here. Your market building expenditures could be for your strategic purpose analytics, for your business analytics, which requires multiple capital approach nowadays, to be treated as your investments in your client's capital. Let's say those types of expenses, why they are called here strategic expenses, these were not regular expenses from the strategic point of view. These were capital expenditures to get your client capital established in the company. And then you will continue building your market, continue working in this area, continue bringing to the company new clients, attracting them, trying to capture them from your competitors. You will still spend your money. So now we can say that you continue investing in your client's capital. The same logic could be applicable for your personnel development as well. R&D expenses, they also require very special attention. I would like to summarize this part of our discussion. Despite those expenses listed in the middle of that table in this slide, they are just expensed due to the standards of financial report, or they are interpreted as the money that you spend within this year and got some benefits only for 1 year. So this is the treatment in financial accounting. But despite of that treatment, in strategic sense, if you have arguments to say those personnel development expenses for training, some qualifications, some courses, some specific programs to upgrade the qualification of your personnel, all these marketing, promotion, advertising, market building expenditures, they brought you to the point when you've got the benefit stream beyond 1 year. Then for the purpose of economic value added calculations according to Stern-Stewart model of economic profit, you should capitalize them. You should interpret them as if they are investments in your client's capital, in your human capital, or in some other components of your intellectual capital. So the equity equivalents are rather different. And there's the most important part, which is strategic expenses. It should be first analyzed, and you should capitalize those expenses, and then you will get these 3 different types of your components of intellectual capital. In case of extraordinary items, you will remove these unusual gains and losses. In case of the reserves, you will convert them from accrual to cash accounting and just try to escape possible accounting distortions.